Welcome to another lesson in accounting. In today's lesson, we're going to look at valuation of inventory part 2. You will recall that in the first part of valuation of inventory, we had looked at the definition of inventory and as well as what would be the effect if inventory is wrongly valued. We've seen the effect on the profit figures as well as figures in the statement of financial position. This lesson will be looking at how to value the inventory. But first, let us look at a scenario. Hello Sam, I need your help. Okay, how can I help you, John? I have some items left at the end of the accounting period and I don't know at what value to record them. John, I don't seem to understand. Can you please be more explicit? So here you see that the conversation between the two colleague businessmen, whereby one is asking the other one help about how to value the items that are left at the end of an accounting period, which we term as inventory. So actually I had purchased them for $400 each and I was selling them for $625 each. At what value should I record each item? That means the question would be like, would the items be recorded at $400 in the books as inventory, or would the items will be recorded as $625 each at the end of the accounting period, that is the inventory? Now I understand your confusion. Let us see the explanation. Let us see how the inventory is going to be valued and what happens when inventory are valued at cost price and what happens when inventory are valued at selling price. Let us look at the income statement extract which is given, and as well as at the end of the year there were goods remaining. Assume that the cost price was $4,000 and the sales value was $6,000. If we value inventory at cost price, that would be $4,000 as closing inventory, giving a cost of sales of $4,000, which we deduct from revenue, giving a gross profit of $6,000. Let us see the effect now if the closing inventory is valued at the selling price. So, selling price being $6,000, cost of sale become $2,000, which we deduct from revenue, gross profit of $8,000. What can we conclude? When closing inventory was valued at cost price, it was $4,000, the closing inventory, and the gross profit was $6,000. But when closing inventory becomes $6,000, the gross profit becomes $8,000, which implies when closing inventory is overstated, profit is overstated. This is what we've seen in inventory valuation lesson part 1. Let us look at a question, or rather an example, as where we have to correct the inventory figure as well as the profit figure. The following figures have been extracted from the books of Solomon at 31st December of each year. You're given the inventory and profit figures at the end of 2016, 17, 18, and 19. Upon investigation of the books, the following were found. Inventory at 31st December 2015 and 31st December 2019 were correctly valued. Inventory at 31st December 2016 was undervalued by $500. Inventory at 31st December 2017 was undervalued by $1,000. Inventory at 31st December 2018 was overvalued by $1,600. And required would be the adjusted figures of inventory and profit for the year at their respective dates. This type of question is very rare, but still it might come for the exam, and this example also help to understand how inventory and profit figures are corrected following correction of an incorrectly valued inventory. First, we prepare a statement like this, whereby we record the figures which were given for the inventory and profit at the end of each year. And then we take one item by one as given in the question. Inventory at 31st December 2015 and 31st December 2019 were correctly valued. Since we are just starting the question, we will not concentrate on December 2019. Let us concentrate on 31st December 2015. Since the closing inventory at 31st December 2015 were correctly valued, this implies that there will be no effect on the profit of 2015. Since closing inventory of 2015 becomes opening inventory for 2016, and since there is no problem with the opening inventory, which implies that the profit figure will not be affected since the opening inventory is correctly valued. Next, inventory at 31st December 2016 was undervalued by $500. Since closing inventory was undervalued, to correct it, we need to add to closing inventory, hence giving a figure of $13,300. And we've seen that when closing inventory increases, profit also increases. Hence, the correction to the profit would be plus $500, giving $9,840. But it doesn't end here. The closing inventory at 2016 becomes opening inventory at 2017. Since closing inventory at 2016 was increasing after correction, hence the opening inventory at 2017 also should be increased, having an inverse impact on profit. Thus, we need to minus 500 for the profit of 2017. You will recall at the start of this example, I've said that inventory is at 31st December. Hence, we are dealing with correction of only the closing inventory. We are not dealing with correction with opening inventory. But the effect of correction of opening inventory should be shown as a correction in the profit figure at the end of the year. We continue. Inventory at 31st December 2017 was undervalued by $1,000, which implies the closing inventory needs to be increased by $1,000 for the correction. Hence, 13,700 plus 1,000 gives 14,700 as corrected closing inventory. Since we mentioned earlier a direct relationship between closing inventory and profit, and since closing inventory has increased, profit also will increase by 1,000, hence giving a corrected profit figure of 10,870. As we mentioned earlier, correction of closing inventory will lead to correction in opening inventory for the following year. Since for 2017, closing inventory was increased by 1,000, which would imply opening inventory for 2018 also will increase. Hence, since there is an inverse relationship between opening inventory and profit, and we said that opening inventory for 2018 will increase, that would lead to a decrease in the profit figure of 1,000, or rather by 1,000. Then, the fourth item, inventory at 31st December 2018 was overvalued by $1,600. Since closing inventory was overvalued, to correct it, we need to deduct. Hence, we minus $1,600, giving a correct profit of $16,800. And as we mentioned earlier, there is a direct relationship. Since closing inventory is decreasing, profit also will decrease for the year, which leads to a corrected profit of $13,130. And we did mention earlier that any correction in closing inventory would lead to a correction in opening inventory in the following year. Since we deducted from the closing inventory, we need to deduct in the opening inventory of the following year. Hence, would lead to an addition to the profit by 1,600. Let us take the first item again, where we did mention that inventory at 31st December 2015 and 31st December 2019 were correctly valued. And we've come to the end of the question. Therefore, we concentrate for December 2019. If the inventory was correctly valued, which implies also that the profit would be correctly valued. Hence, the correct figure for 2019 would be 22,870 after correction of only the opening inventory. So, this question needs a lot of concentration because there is always the link between closing inventory of the current period and the opening inventory of the following period, and as well as the relationship between closing inventory and profit and opening inventory and profit. Let us look at now the rule of inventory valuation. In order not to overstate or understate profit, inventory should be correctly valued. That is, inventory is to be valued at the lower of cost and net realizable value. What is meant by cost? Cost refers to what has been paid to acquire the inventory item and any other direct cost incurred to convert into finished product for a manufacturing concern, which is known as conversion cost. What is meant by net realizable value? Net realizable value refers to the difference between realizable value, that is, the price at which the item can be sold, and the selling expenses, also termed as realizable expenses, that is, expenses incurred to put the item into saleable condition. Therefore, the rule of inventory valuation, which says the lower of cost and net realizable value. Let us look at example 1 to understand. Inventory item cost $1,100. It can be sold for $1,300 if further expenses of $250 are incurred to put it into saleable condition. At what value should this item be recorded in the books? First, we need to identify the cost and the net realizable value. The cost is $1,100. The net realizable value is the realizable value of $1,300 minus the expenses to put the goods into saleable condition. That would lead to $1,050. And applying the rule of lower of cost and net realizable value, the inventory item should be recorded as $1,050. If the inventory is recorded as $1,100, which is more than $1,050, that would overstate the profit. Hence, that is why the rule should always be applied. That is, inventory to be valued at the low of cost and net realizable value. Let us look at a second example. A trading concern has three types of inventories in hand and at end of a certain period as shown below. You've got three items A, B, C, the cost, the selling price and the selling expenses. At what value should the inventories be recorded in the books? For item A, the cost $450, selling price $600, selling expenses $100, which would lead to the cost $450 and net realizable value of $500, hence which is lower between the two is $450. For B, the cost $530, selling price $650 and selling expenses $80, hence giving a net realizable value of $530. Which figure to take? Any one, because they are both the same. For item C, the cost is $370, selling price $400, selling expenses $50, giving a net realizable value of $350. And applying the rule, we take the lower of the two. Hence, applying the rule for A, B, and C, for A we take 450, for B 530, and for C 350. Hence, the total value of inventory would be $1,330 to be recorded in the books as closing inventory. Now let us look at late stock taking or inventory valuation at statement of financial position date. What is meant by this? Sometimes inventory is calculated or given at a given date or at the end, and where we are required to calculate inventory at a date much before the date given. Sometimes it might be the statement of financial position date or at start. Hence, if the inventory which is given and the inventory which we are required to calculate, there will be a gap. And that gap, or rather during that gap, the business will continue to operate. And when the business continues to operate, there will be inventory that comes in. We need to identify the ways through which the inventory comes in. One would be purchases. Also, during that period of operation, there would be ways through which inventory would be going out. And one way would be sales. And since we are dealing with inventory, which is always valued at the lower of cost and net realizable value, here we're going to take the sales at cost. Another way that inventory comes in would be sales returns, but we're going to take it as sales return at cost. Another way, inventory that will be going out, purchases returns, inventory destroyed, free samples given, free gift given, drawing of goods, and as well as loss in value of inventory. These are the ways through which inventory goes out, and the two above, the ways through which inventory comes in. Let us look at a work example. Abba was not able to carry out her stock taking at end of period 31st December 2018. Instead, she was able to compute the value of inventory at 12th January 2019, which stood at $12,800. Clearly, we can see There are two dates and inventory has been given on 12th January 2019. We need to work backwards to calculate inventory at 31st December 2018, given the transactions that had taken place, such as purchases, sales, sales return, purchases return, drawing of goods, loss of inventory value, and as well as free samples. But we need to be careful. The sales is at invoice price, the sales return is at invoice price. And here we require the knowledge of ratio analysis, that is how to convert invoice price into cost price using the concept of markup margin. And as mentioned, calculate the value of inventory at 31st December 2018. How to do this type of calculation? First, we need to draw our statement. Statement to calculate inventory at 31st December 2018. There will be one column where we'll be adding to the figure, one column where we'll be deducting from the figure, and then the balance column. And we're going to start with the figure that is given at the end. That is inventory at 12th January 2019. The figure given, $12,800. And we would be required to calculate inventory at start, that is at 31st December 2018. This is what will be required to calculate. So the first item given, purchases, 2,300. Now, be careful. The human mind is more adapted to saying, I add what comes in and I deduct what goes out. Therefore, we start with the unknown because the unknown comes at the beginning. That is the starting date. Therefore, purchases, we are going to add. Therefore, record in the column add. Sales at invoice price, 4,800. We all know that sales can also be used in terms of the word revenue. So since it is at invoice price, we need to use the concept of markup margin. If markup is 33 1/3%, that is 1/3, margin would be 25% on sales, that is 1/4. Hence, sales at cost after the calculation, deducting the margin, would be $3,600, which we record in the column to deduct. Next, sales returns at invoice price. Again, we need to convert because it is given at invoice price. Hence, since markup is 1/3, margin would be 1/4, representing 25%. The calculation would be the invoice price minus the element of margin. That will go in the column to add sales return at cost, $270. Next, purchases returns 100. Purchases returns, that is the goods going out, we need to deduct 100 in the column to deduct purchases returns. Next, ABBA withdrawn goods 120 for personal use. This represents drawings. Since goods are going out, we need to record in the column to deduct drawing of goods 120. And then on 31st December, she discovered item of inventory cost 500 worth only 320. That is a loss in the value of 180. Since the loss in the value would mean a reduction in the value of inventory, it will be recorded in the column to deduct. Next item, also $240 worth of goods were given as free samples. Since inventory going out, we're going to record in the column to deduct free samples 240. Since these are the only 7 items that were there in the question, we calculate the total of goods to add 2,570 representing the total amount of goods that came in during the period. The column to less, 4,240 representing the total amount of goods that went out during this period, giving a net figure of 1,670. Hence, moving upwards, we get opening inventory at 31st December 2018, 14,470. Since this is the last figure that we calculated, it will be termed as the balancing figure. This statement shows how to calculate inventory at a certain date, given inventory at a different date, and we have to follow the sequence, whether goods come in or goods goes out, and as well as to convert any invoice price into cost price using the concept of markup and margin. So in the combined two lessons, part 1 and part 2 in inventory valuation, what we need to remember: the rule of inventory valuation, the effect on profit for the year of a wrong inventory figure, the correction of profit figure, as well as late stock taking.
Thank you for your attention.